Are builders the last line of defense on a teetering real estate market? While existing home sales have plummeted down a staggering 28% below pre-pandemic levels, new construction sales are absolutely soaring, up 32% over that same period. Builders are pulling out all the stops, making aggressive affordability adjustments to keep the market afloat. They're slashing prices, offering mortgage rate buy-downs, and even downsizing the homes. Are these practices even sustainable? Divergence often precedes market downturns. Is that what we're seeing right now? This dramatic divergence between new builds and existing homes isn't just a trend, it's a flashing red warning sign. Historically, such divergences highlighted underlying weaknesses in the market that could spell trouble ahead. So while builders are doing their part to prop things up, could we be ignoring the cracks forming just beneath our feet? Why are existing homeowners so stubborn, refusing to lower their prices even as the market shifts beneath them? The lock-in effect has them clinching to ultra-low mortgage rates, choking the very supply of existing homes and pushing buyers towards new construction. Builders, on the other hand, operate like, well, a business, because that's exactly what they are. They're adjusting prices and offerings to keep sales humming. But at what cost? This isn't just about numbers, it's about a market potentially on the verge of a major correction. The divergence we're seeing could be the canary in the coal mine, signaling deeper issues like overvaluation and unsustainable practices. And let's not forget, divergence in real estate often precedes market downturns. So are we headed for a rough landing? Let's look at some unsettling truths hidden beneath the statistics. How are builders stepping up, but also how their actions might be masking the market's underlying fragility? Let's look at different types of divergences, regional valuation, price versus volume, and what they mean for you. The decisions you make could now have a long-lasting impact on your financial future. Is this the calm before the storm? Are we on the edge of a housing market meltdown? This wild split we're seeing between existing home sales and new construction, you got on one hand, existing home sales have taken a nosedive down a shocking 28% below pre-pandemic levels. On the other hand, new construction is not just holding steady, it's soaring 32% above those same pre-pandemic benchmarks. First off, builders are playing a different game. They're nimble, they're strategic, and they're not afraid to make bold moves to keep the wheels turning. With mortgage rates spiking, they've stepped up with aggressive affordability adjustments. We're talking about price cuts, mortgage rate buydowns, and offering smaller and more affordable homes. They're meeting buyers where they are, making homeownership more attainable even when borrowing costs are higher. Meanwhile, existing homeowners are stuck. They've locked in those ultra-low mortgage rates from a couple of years back, and they're clinging to them for dear life. The idea of trading a 3% rate for a 6% rate, literally doubling their interest rate, just isn't that appealing as you can imagine. It's a financial gut punch. So they're staying put, and that's choking the supply of existing homes on the market. This lock-in effect is real, and it's causing a supply crunch in the resale market. Sellers are reluctant to budge on their prices because, frankly, they don't have much incentive to sell. Buyers looking for deals in the existing home markets are hitting brick walls, and many are turning their gaze into new construction where they find more flexibility and options. So we've got this stark divergence. Builders adjusting and thriving, existing home sales stagnating. It's a tale of two markets moving in opposite directions, and it's reshaping the real estate landscape in ways we cannot ignore. Now, let's talk about why this surge in new construction isn't just a silver lining. It's a beacon of hope for our local economies. New construction isn't just about putting up houses. It's about fueling a vast ecosystem of jobs and economic activity. Every new home built pumps money into the pockets of tradesmen and women, carpenters, electricians, plumbers, roofers, you name it. It's a chain reaction that stimulates growth well beyond the construction site. Think about it. When builders ramp up projects, suppliers see increased orders for materials like lumber, steel, and concrete. Local businesses benefit from the influx of workers needing meals, gas, and services. Even municipalities gain from the permits and taxes generated by the new developments. In a time when other sectors are wobbling, new construction is stepping up as a vital economic engine. It's helping keep unemployment rates down and injects much needed vitality into communities. Without it, we'd see a lot more stagnation and a lot fewer opportunities for working class folks who rely on these jobs to support their families. We can't underestimate the ripple effect here. New construction supports industries ranging from manufacturing to finance, mortgage lenders, real estate agents, and home inspectors. All of them benefit from when builders are active. It's a comprehensive boost that helps stabilize the economy during times we are experiencing like right now. So while the divergence we're seeing raises some red flags, the strength in new construction offers a counterbalance. It's propping up the market, providing jobs, and keeping the economic gears turning. In a way, builders are doing more than just constructing homes. They're constructing resilience in our economy. Divergence isn't just a fancy term. It's a powerful indicator that can reveal underlying weaknesses or strengths in a market, whether it's the equity market or the real estate market. In real estate, divergence can manifest in several ways: regional, valuation gaps, price versus volume discrepancies, and even technical analysis signals that the average person might actually overlook. All right, let's break these down. Regional divergence. This is when wealthy states or regions grow faster than poorer ones. Right now, we're seeing some regions booming while others lag behind, creating a fragmented market that's hard to read at glance. Valuation divergence. This refers to the difference in capitalization rates between public and private real estate markets. In simpler terms, it's about how different investors value properties, and significant gaps here can indicate mispricing or looming corrections. Price and volume divergence. This happens when the price of residential land transactions don't match up with the volume of those transactions across different cities. For instance, higher prices but low sales volumes could suggest that properties are overvalued and buyers are hesitant. Technical analysis divergence. This is when the price of an asset moves in the opposite direction of a technical indicator. In the stock market, traders use this to predict reversals. It can apply to real estate markets too. If prices are rising but indicators suggest weakening momentum, a downturn might be on the horizon. Why does this matter? Because the divergence we're seeing between new construction and existing home sales is a form of market divergence that could signal deeper issues. Builders are adjusting and adapting, but existing homeowners are standing pat, creating a disconnect that's more than just numbers. It's a symptom of structural imbalances. Understanding these different types of divergences can give you a clearer picture of the market's health and help you make more informed decisions. Whether you're considering buying, selling, or investing, recognizing these signals can be crucial. Let's talk a little bit about the affordability cuts builders are making. On the surface, it sounds like a win-win, right? Buyers get homes at a more attainable prices and builders keep sales rolling. But let's not kid ourselves. There's no free lunch here. These price cuts, mortgage rate buydowns, and incentives are eating into builders' profit margins. Major players like D.R. Horton, Pulte Group, KB Home, and Lennar have all slashed their average sales prices since the peak during the pandemic housing boom. We're seeing declines ranging from 4 to 13%. Lennar, for instance, is down 13.2 from its peak. And that's after spending an average of $44,000 per home on incentives in Q2 2024. Think about that. Over $44,000 per home just to make the sale. That's not chump change. That's a significant hit to the bottom line. Builders are essentially buying down interest rates, covering closing costs, and reducing prices to meet buyers in this high rate environment. They're compressing their margins to keep the engine running. But what is the long-term cost? These affordability adjustments are a double-edged sword. While they keep new home sales buoyant and support the broader economy, they also strain the financial health of these companies. The builders are walking a tightrope, balancing the need to maintain sales volume against the erosion of profitability. It's a high-stakes game, and the stakes are getting higher as affordability remains a pressing issue. But here's the kicker. These measures might not be sustainable. Shocker. There's only so much fat to trim before you hit the bone. If builders continue down this path, they risk undermining their financial stability, which could have ripple effects throughout the economy. It's a precarious situation that demands our attention and the builders' attention. Now, let's talk brass tacks. There's a ceiling to how many price incentives and cuts builders can offer before the model breaks. Profit margins aren't infinite. They're already being squeezed like never before, while builders have some room to maneuver thanks to gains during the housing boom. These reserves are not bottomless. Consider this. Even though the average sales price are still above where they were in Q1 2020, the recent downward trends are alarming. The average price gain among major builders since Q1 2020 is about 24%, but that doesn't paint the full picture. The cost of materials, labor shortages, and regulatory hurdles have all increased. So while sales prices for error is shrinking, at some point, the math stops working. Builders can't keep offering generous incentives without seriously denting profitability. If they cut prices too much, they risk devaluing neighborhoods and triggering a race to the bottom. If they pull back on incentives, they risk alienating buyers who are already stretched thin by high mortgage rates and the economic uncertainty. This is the crossroads where tough decisions have to be made. Do builders continue to absorb the cost to keep sales volume up, or do they pull back and protect their margins, potentially slowing down the market? Neither option is without risk, and both have significant implications for the housing market and the economy at large. The bottom line, builders are reaching the limits of what they can do to prop up the affordability. The initial strategies that kept the market afloat may not be sustainable in the long run, or in the short run, frankly. If profitability continues to erode, we could see a slowdown in new constructions, layoff in the industry, and a tightening of credit. That, my friends, could be the catalyst for a broader market correction. Folks, the bold moves by builders, a stubborn standstill of existing homeowners, and the critical concepts of divergence that ties it all together. Understanding these dynamics isn't just interesting, it's essential for anyone making real estate decisions right now. If you found this video insightful, make sure to like, subscribe, and stay updated with the latest trends impacting your financial future. Got any thoughts or questions? Do me a favor, drop them in the comments below. I read all of them and would love to hear from you. Thanks, as always, for joining me. My name is Darin Hunter, and that is another guaranteed video. Have a great day.